All right, welcome to the next installment of Non-Consensus Investing. It's a podcast from Lumida. You can find it on Apple, Spotify, YouTube, here on Twitter, LinkedIn, all the rest. I'm joined by Dave Lambert, who's managing director of RightSide Capital. And RightSide, I put in the bucket of non-consensus venture. And we're non-consensus investors. We're going to unpack what that means. They're a top decile venture fund, and they take a very unique approach. And I want to get into that right now. Dave, do you want to frame up RightSide Capital? Like what size, stage, typical check size approach that you take?
Certainly. Like, so our 1 minute description is we would describe ourselves as a quantitative, data-driven approach to what we call pre-VC stage investing. And I think, there's many unique things about us. The fact that we're sort of quantitative and data-driven instead of qualitative-driven. We address the stage of the market that everyone else sort of ignores. And, pre-VC stage for us is companies raising rounds that are generally too small for the venture world to address. So we're focusing on companies raising sub $500,000 total round sizes. And then probably the most unique thing about us is that our funds are ultra diversified. So instead of having 15 or 20, maybe 30 companies in each fund, each of our funds has many, many hundreds of investments.
Right. So there's quite a few things already touched on there. Number one is you're taking advantage of the power law of returns. Number one. Number two, you're first money in, which means you're getting a fantastic valuation. We'll come back to that. And that goes back to another principle we have at Lumina. It's called, you make your money on the buy. And there's some other features about your approach. Like you don't exercise, your pro rata as a general rule. So can you talk about the approach you take? Most VCs have a thesis or a theme that they're tracking. And when you're writing that many checks, how do you make that work at that size and stage when you can't cover that many names or do that level of diligence?
Yeah, I would say that like our thesis or theme is actually an entire segment of the entrepreneurial ecosystem that just is largely ignored and unaddressed by professional investors. And therefore, supply and demand tends to be solidly in our favor. And it's the segment of the entrepreneurial ecosystem where founders need the money the most. So, we would say that in most traditional stages of venture capital, sort of seed stage and beyond, even really often pre-seed and beyond, it's a pretty crowded market that's getting more and more efficiently priced as time goes on, and information parity sort of becomes more the norm. And the market that we focus on is just a much more inefficient, dysfunctional market. It's where a lot of people view that friends, fools, and family lose their money. It's these small rounds where the check sizes and total round sizes are just too small for professional investors to generally address. And so we think this entire segment of the market is just sort of substantially outperforms the traditional venture capital stages from a return perspective. So that's our big thesis, is going after this stage. And then we do it in a very unique way because we have this quantitative, data-driven approach. So we really invest in profiles of companies at this stage more than we invest in an individual company. And that's,
Let's come back to that too in a moment. So you're going after this underserved segment where there's a capital imbalance, which I also like too, because you're not facing competition from other VCs. There are a couple thousand VC firms out there. There's 700 VCs in crypto by my count alone. We're already seeing valuations have run up quite a bit. We had a temporary VC bear market. Valuations recalibrated. What does your entry valuation look like?
Yeah, we're typically entering anywhere between, I'd say 80% of our investments are somewhere between a $2 and $4 million valuation.
So that's the primary driver, I believe, of your outstanding performance, because you're getting in at such a low valuation and you combine that with the QSBS tax exemption. We should double click. You should define that so that you can get an exit at a 30 or $40 million. And that's a home run. And the exit for you, that valuation might be the entry for another VC who's doing a seed stage deal in an AI startup.
Yeah, almost every stage at which we can potentially invest, whether it's tens of millions, hundreds, or even the low billions, it's not uncommon that we're selling to new investors that are coming in. So
Right.
our exit, which can be, tens or hundreds of X in multiples, is where other people are starting. And that's just because we're beginning at this stage that's much earlier. And one of the sort of the misnomers is when people hear the term pre-VC stage, they assume that refers to sort of a traction level and that the companies that we're investing in are all ideas on paper. But that's actually not true at all. Almost everything we invest in has revenue. It usually has 5 to 30K MRR. And it's just that we're sort of picking the cream of the entrepreneurial crop. These are companies that are very capital efficient, and they often have traction levels that are consistent with what you might see in $1 million to $2 million pre-seed or seed round, venture capital round. And we're just getting companies that don't happen to have that same level of traction, but they only need $300,000 or $400,000.
And you're getting fantastic outcomes. Obviously, DigitalOcean is one. I was a late stage investor in DigitalOcean, actually. Then, of course, that went public, which is a cloud startup. TradingView, which I imagine a bunch of people listening now have used. I use TradingView as well.
Yeah.
PillPack, which was acquired by Amazon. So these are startups that people recognize. So your value drivers are: one, you get a good valuation; two, you have a traction requirement; three, the QSBS and the torque on that. We'll come back to that in a bit. But why would an entrepreneur take your money at that valuation?
Yeah, there are a few things here. So number one, a lot of people think that it's just easy to raise money, or if you're raising a small amount, it's fairly easy. It's incredibly difficult to raise capital at every stage for a company. It generally takes the same amount of time to raise 300,000 as it takes to raise 30 million. And if anything, at earlier stages, it often takes longer. So we have two really strong value props to entrepreneurs. The biggest one is that we run this completely transparent, fast funding process. So you can just go to our website. We say exactly what our target investment profile is. We're gathering up data points on you. If we're investing, we give you a quick yes. If we're not, it's a quick no, and we tell you exactly why. And if there are some metrics you could hit at some point in the future to turn us into a yes, we'll let you know what those are. And, a typical conversation with the founder might go like this. So let's say I'm talking with you, Ram, and you're, part of a founding team, and maybe you're looking to raise, $1 million at a $5 million valuation, and you've got some certain level of traction. You've come into our fold. And I'll always be completely straightforward with any founders that come in contact with us. And I might tell you, hey, Ram, I think at your level of traction, you can probably get the round done that you're looking to raise, but it's probably going to take 5 to 6 months of full-time fundraising. Your business model is very capital efficient. If instead of raising $1 million, you're interested in raising a $300,000 to $500,000 round, we could gather up a bunch of data points, give you a quick yes or no. And if we got to a yes at your level of traction, we'd invest at a $3 million valuation, and we could give you a yes or no next week and fund immediately. And it's very interesting what happens. The more experienced and repeat entrepreneur you are, the more likely your next question is, did you just tell me you can give me a yes or no next week and then fund right away? And I'll say yes. And then the next response is, great. What do we do now? You just saved me 5 months where I can now spend time on operating instead of fundraising.
So you're seeing some positive select on the founder quality because they've got traction. They'll take some cash now, maybe less cash, and then grow into a larger later round. Is that the idea?
Yeah, and maybe they skip that $1 million round and they use our money and they grow in the next round's a $1.5 or $2 million round at an $8 or $10 million valuation. And the selection bias is something like when we started back in 2012. If you had asked me in 2011, what's the biggest risk to your model, I would have said negative selection bias risk. What if it turns out that it's only, for some reason, the worst companies or the worst founders that are attracted to our model? And that's what we end up selecting out. As long as we had sort of no bias, significant bias, we thought we were okay. But it turns out we actually have a very strong positive selection bias. Very young, inexperienced founders that have never done it before don't appreciate how difficult it is to fundraise. And they're also very emotionally attached to valuation. Whereas experienced repeat entrepreneurs know that fundraising is this enormous distraction, takes up 70% of your time, and that if it's a small round, the dilution isn't that large anyway. So it actually turns out our value prop resonates the strongest with the best entrepreneurs. So we're actually thrilled when we found that out, but it took a couple of years to fully realize that.
So what's the end-to-end turnaround time for a typical experience where a founder is ready to rock and roll? They've got all their data prepared.
Yeah, so if a founder has all their data prepared and they come in, they fill out our pre-screening form on our website, we'll recognize pretty quickly if they're sort of within our general sweet spot. Might ask a few questions, have a call with them. Usually on that call, since we already know a lot about them from the pre-screening form and info they've provided, I'm going into that call, or one of my partners is, knowing the 4 to 8 questions we want to ask already. Now, we don't end up having a 5-minute call. It ends up being a longer call. And usually right on that call, if it's really in our sweet spot, I'm going straight to valuation, what size round we would likely do. I'm talking about our process. Here's how it would work. After this call, I'll send you an email with a list of diligence items that we're going to want to look at before we get to a firm yes or no. And once you get that to us, we'll look it over and usually get back to you within a day or two with a yes or no or some follow-up questions.
How do you validate the revenue? Because that's key, right? You have the traction. Yeah. And if you're moving that fast, you're doing that many deals, there's always going to be some kind of fraud that's trying to take advantage of that speed. So how do you ensure that the revenue that they're representing is valid? It's
actually much easier than you think, because we're dealing with companies that have pretty low revenue in the scheme of things. So if someone has 12 customers and 15K MRR, great. Give me your list of customers, show me signed contracts for the top 6 largest ones, and show me bank statements from the last 3 months, and let me see the money flowing in and out. Or let me see a Stripe report that's showing that. So it's fairly easy. What's very interesting is that we're making decisions based off of quantitative data. So everything that we make a decision on, the question we ask, the answer is either a yes, a no, or a number. And it turns out you can gather up that data much more quickly, and you can make a decision much more quickly than when you're trying to make a qualitative decision, because it could take me or an associate 4 or 6 weeks to model out their market and determine how we think it's going to grow, right, and weeks to figure out what their competition matrix is and all this other stuff. It's the qualitative decision-making process that really takes a very, very long time.
And that's another difference between your approach and most VCs, including other investors. I'm a thematic investor myself. And so we're looking at what the themes are. What is the competitive landscape? Who has a leadership position? What's the right approach? And you don't have to do any of that. You're taking a very different approach. You're doing these binary yes, no. What are the kinds of questions you're asking to measure?
Yeah, so it's really like, what are the main quantitative data points that we look at? And I'll say up front, it varies a lot by type of business model, but I'll talk about some that sort of transcend all business models. So I'd say that the primary things we look at are, what's your revenue? Most of the things we invest in are subscription recurring revenue. So what's your MRR? What's your growth rate? How much capital have you raised to get to that point? How much capital are you burning each month right now? So what's your cash burn? What's your average price point? Is it a high ticket SaaS or a low ticket? In other words, can sales be driven by a sales force that you control, or are you having to do inbound marketing and self sign up? And then, characteristics of the founding team. And I think founding team's an easy example of some quantitative stuff. Like, most companies, when you're trying to evaluate the founding team, as a VC, you're trying to determine, or as an angel investor, will these entrepreneurs walk through a wall to accomplish what they want to accomplish? Do I think they have the right personality? Ultimately, you're trying to assess, are they like me? Because everyone likes me, whoever that me is, whether you're aware of it or not. And instead, we just say, all right, what are the things we look for in a founding team? We like repeat entrepreneurs. They've been CEO or founder of a startup before. They've managed people and budgets. We like founding teams with some technical expertise, technical founders. And we like teams that have domain expertise where they're at. And if that's what I want to find out, I can figure that out very quickly and easily. And then what we're really doing is trying to assess whether a team's average, above average, or below average. And sometimes if it's below average, meaning it's a bunch of young entrepreneurs that have never done it before and it's higher operational risk, that can knock us to a no. But often it doesn't knock us to a no, it knocks us to a lower valuation. It's a different risk reward profile, so our reward has to be greater. And what's interesting is that when we tell entrepreneurs this and we're completely honest and straightforward, the response is so positive. So if I told you, Ram, hey, you and your two co-founders, when we look at your company, the biggest risk profiles, the three of you have never done anything like this before, and it's just greater operational risk. Normally, we'd fund a company like yours at 3 million. This isn't going to knock us to a no, but we're going to do it at a $2.4 million value.
Right. So you price it appropriately, which is a risk-adjusted return concept.
Correct.
I like. There are no bad assets or assets at appropriate prices. There's still some bad assets out there.
That's one of the most, something that you mentioned there is so interesting because it's so anti-VC thinking. The traditional venture view of the world is there are just good companies and bad companies. And all that matters is you get in the good companies, it's binary outcomes, and the valuation doesn't matter that much. You just need to get in. If you took that investment approach and you went to an investment committee at some large endowment on the public side, and you tried to make that argument for a public stock and pricing doesn't matter, you'd be fired and laughed out of the room.
Look at Snowflake. It's got a forward PE of 160 after it's down double digits. Look at Tesla, forward PE of 60. Again, it's down double digits. I absolutely agree. It goes back to the earlier point. You make your money on the buy. You got to price it appropriately. Look at risk and reward together. And if there's some dents in the car you're looking to buy, then you should receive a discount for that. That compensates you for that opportunity.
Yep. And so, yeah, we're strong believers that pricing matters a lot. It's one of the most important things, and it's pricing. It's just not pricing in a vacuum. It doesn't mean that, hey, you're always better off investing at 2.5 million instead of 4. It's pricing relative to the profile of the startup that you're investing in.
So the entry valuation is face-meltingly good.
Yes.
We have a lot of friends, clients, partners that are VCs. And I've shared your story with them privately, and they're like, huh? So let's talk about the accelerator dynamic. How do you source that volume of deals?
Yeah, so we do lots and lots of direct deals. We actually are minority owners of 2 different startup accelerator organizations where we get a small piece of every company going through. We're synergistic and work with lots of accelerators. So that the typical startup accelerator model is you get these companies coming in, they're selling in the accelerator a piece of equity at an under market value. And then all investors are looking at these companies when they have their demo day at the end of the program.
Right.
Because we're so fast, we work with lots of accelerators around the country, and those managing directors introduce us to the companies on the way into the program, or maybe 3 or 4 weeks in.
You're cherry picking, and you can intercede before the demo day.
Right, because we don't distract them from making a decision. Right, so we cherry pick, and it's, you get a better valuation when you're giving someone 200,000 of 200,000 versus being 200,000 of a $1.5 million round. You just always do.
Right. And what fraction of deals come from accelerator channels versus direct deals?
A pretty high percentage come from accelerator channels, particularly when you factor in the ones where we get just a small piece of everyone going through. Those dollar values we get in are lower there. Sometimes we get a little piece and then we go in mid-program and we invest a greater amount. So like TradingView was a good example of that. So we helped put together the group of investors that was part of that funded the 100K note on the way into Techstars for the first 6 years it existed. We were the largest investor, check writer there. And we went and we met with every single company 2 to 3 weeks into the program. And me and one of my partners were in Chicago meeting with all the companies. We met with TradingView, and 15 minutes after talking with them, it was like, wow, check, check, check. You tick every box that we look for. They had like 10 or 12K revenue, which was the monthly revenue, very unheard of then. They were very capital efficient, hadn't raised anything, very low. They're almost break even at that point. And their founders had 10 years plus years domain expertise in financial charting software and creating it. So we just on the fly offered them another $100,000 at 3 million, and they took it right there. And what's interesting is that if you look at that company from a traditional venture view of the world, nobody would have invested in them. Like that business model was, it's a B2C, fintech subscription model targeted at home active traders and commodities, stocks, currencies. Most people would be like, how many at home active traders are there anyway? And because it was freemium, it meant they only got money from 2% of their users anyway. And that 2% was paying them $15 a month, something like that. So you just would think the math could never work out, that you could acquire users if you had to actually go pay for them. But from our perspective, it checked everything we look for, for the right profile of company, and it fit.
Right. So your evaluation criteria don't include discernment or assessment of the business model per se. I mean, your questions aren't looking at, hey, is this going to disrupt TradeView, the next Bloomberg, whatever software is out there?
Here's the really hard thing is that, and we discuss this a lot internally, at the stage that we invest, when companies are so early, there's two interesting characteristics that come into play. Number one is our really successful companies, half the time they look nothing like what we invested in anyway, because they pivot and change their business model along the way, which means that 100% of the diligence that you would have done on their business model was useless.
Goes out the window
anyway.
Quickly. Right.
Yep. Number two is that the difference between revolutionary and ridiculous is zero at the stage that we're looking. And in fact, if you try and screen out the ridiculous, and particularly if you ask experts in an area, can you screen out these ridiculous ideas? Because I want to find the revolutionary. They're going to screen out the revolutionary ones.
Give us an example or two of that, where your instinct said, you know what, I don't want to do this deal, but my evaluation criteria checks all the boxes. We're going to write the check.
I would say our three of our largest direct investment best outcomes all fit that. And if you had asked us when we invested on a scale of 1 to 100, how likely is this business model and company to be a unicorn, we would have put them in the bottom 20th or 30th percentile. And you just can't tell. So that's an example. We would never think a freemium business model where the people
TradingView is a good example of that.
$15 a month, that's never going to be successful and get to hundreds of millions of revenue and be wildly profitable. But it did, right? We have another company called Kami, and it's based in KAMI. It's based in New Zealand, one of the most successful startups ever in New Zealand. And when we invested in them, it's one of the rare ones we did that was pre-revenue at the time, because they had just this rapidly growing user base, and the engagement was off the chart. And it was just a sort of collaborative PDF plugin for Chrome. It's they had no business model, but it was growing so quickly. We're like, all right, with this growth and user engagement, they're going to be able to figure something out. But if you look at the path that they went on, it almost made us cringe along the way, because the first thing they did is they came back and they said, all right, we've discovered a way to monetize. We're going after individual contractors, out there, real estate agents and contractors, that we can sell this at $40 to $80 a month. Which, if you're a VC firm, that's you just want to put your fingers in your ears and go la 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 and run out of the room if someone tells you that's their target customer. But they actually did it and got revenue. And then they came back and said, we're actually pivoting to target K through 12 education, because we think we can sell there, which is just another target customer base that you sort of want to cringe and run away from. It's so hard to be successful there. And yet they did, and they got to millions of revenue. COVID hit, they got turbocharged. And now they have tens of millions of revenue, wildly profitable, and no one's ever heard of them because they did it all hardly raising any money, you know? And at every step in the way, we would have thought, gosh, this is a bad decision. Maybe.
You have to be investing in a lot of cringe, but your process doesn't allow your subjective assessment of that model and industry.
And I don't know if it would say cringe, but crazy. Sometimes we just roll our eyes and we're like, I can't believe we're investing in this, but it checks everything. And we actually, that's the hardest part about being sort of quantitative data driven, is going with what that process says and not letting your gut override it. Because, if you look at my background, I have never had a real job. I graduated college in 1992. For the next 2 decades,
I started Stanford.
Yeah,
Right.
from Stanford. I was entrepreneurial. I started and founded and ran 2 different tech companies over the next 2 decades. One was a hardware
Yeah.
company, one software. Active angel investor from the mid 90s to mid 2000s. I've been a VC now for 15 years. I feel like my gut should be really accurate.
Right. You should have good
Really
instincts.
good
You should have, yeah, exactly.
and yet the data shows that it's just not going to be nearly as effective as I think. And so we actually engineer out of our process any ability to discuss if an idea is crazy or sensible.
Did you stumble upon these principles after seeing evidence that it works? As you're looking like a historical assessment of investments you did and didn't you do some reject inference and say, you know what? Hey, here are the principles we should hold ourselves to. Or when at the outset, did you and your partners come together and have this insight? This is the right way to do venture.
It's an interesting origin story because the sort of the genesis of the idea came from one of my partners, Kevin Dick, and Kevin's sort of one of these quantitative math minds who dreams math models in his sleep type of person. And he was reading a new book that had come out in late 2007 called The Black Swan by Nassim Taleb, which became famous in the financial crisis. But Nassim Taleb wasn't so famous then, and this wasn't a famous book. And Kevin read the book and he had this aha moment. He said, Nassim Taleb is talking about the black swan as sort of these negative surprises. But he said, I believe that every successful tech startup is really a positive black swan. And the concept of a black swan is that in foresight, it's an event that everyone thinks is just impossible to happen or incredibly unlikely. And then once the event happens, everyone weaves in this narrative about how it was obvious and they knew it would happen. And so at the time, those were companies like Google and Facebook were good examples. So Google, It was a totally crowded market in search, and it was looked at as being solved.
They're number 18. Right.
Yeah, exactly. Alta Vista, Excite, Yahoo. They're just, number 18. Right. And you had Facebook, and there was already Friendster and, and all, and
6 degrees of separation, MySpace.
Yeah. Between MySpace and Friendster, it's like, who needed another one? And then all of a sudden, a few years later, once they were successful, everyone's talking about how it was so obvious. And these were ready for
well, the narrative follows price, mythology shows up later, and then people reverse engineer to this perfect story. Talk a little bit more about the QSBS. That's another tax element. And the best investors in the world are conscious about tax. Charlie Munger and Warren Buffett, highly conscious about tax. Could you just thumbnail out QSBS for those that are not aware of it?
Yeah. Let me do that. Let me actually take 30 seconds and describe our investment model in a slightly different way and then flow into QSBS. So we came up with this investment strategy that we thought would sort of work really well for this pre-VC stage. And it has to do with catching, the tail outliers with high certainty. Like most of the returns are in the 1 in 20 to 1 in 100 outcomes. And we wanted to create a way to capture that tail return with high certainty. And so part of that is ultra diversification, but ultra diversification also solves for the fact that most of our investments go to zero. Most of them lose money. So we wanted to be able to address this segment of the entrepreneurial ecosystem in a relatively low risk way. So we would come up with a strategy where, we'd capture the returns of this high returning market. Most investments lose money, and then a small percentage return, crazy multiples and play out over a long period of time. So this is the investment strategy that we had, and we had never heard of QSBS when we were coming up with this. And then all of a sudden, and it turns out QSBS has been around for a while, but in 2010 or 11, a change was made to it such that it applied to 100%, 100% of your gains up to a certain amount, factored into QSBS. And what QSBS stands for is Qualified Small Business Stock. And what the IRS has said is that if you invest in a qualified small business, which is a US C Corp that primarily does business here in the US, and you purchase stock in that company when it's pretty low assets, if you hold that stock for over 5 years, then 100% of your gains up to either 10x your basis or 10 million are tax-free federally. And it turns out that about 45 or 50 states follow federal guidelines and just start with your taxable federal income. So it means it's
of your basis or 10 million. Is it max or either or do you pick?
It's It's max, either or. It's like max. And so it's tax-free and federally and in 45 of 50 states. And for us, it means we can get crazy return multiples, because if we invest 200,000 into a company, our first 50x of gains is tax-free federally, but it's actually much better than that. We almost, even if we get a 200 or an 800x return, it's tax-free 100% for all of our investors, because that 10 million cap is not per investment, it's per taxpayer per investment. So we could have 100 million in gains from a single investment, and then that flows through to our funds, and each taxpayer within our fund gets their own 10 million of tax-free gains. And so what happens is, it just turns out that our strategy is we get these very large winners. We almost always hold them for more than 5 years. And so the gains end up being almost completely tax-free. And then there's this other segment of the tax code that even 9 out of 10 people in the VC world have never heard of. And it's called Section 1244. And it states that if you're part of the first $1 million into a QSBS company and you lose money, that loss can be an ordinary income loss instead of a capital loss, which is enormous. It's just
another
a tax
big
credit.
benefit. I think without the QSBS exemption and Section 1244, the returns on venture as an asset class would simply be not that attractive for the vast majority of venture investors. So just to take a step back, so you make your money on the buy, you've got a 2 to 3 million entry valuation. 2, you've got an MRR traction requirement. 3, you're sourcing from accelerators, and you can cherry pick and intercede within those accelerators. 4, you've got the tax code working for you. So you put that together, and now you've got a top decile venture fund.
Yeah, exactly. And I think the biggest thing is, like, part of it is us being good, and part of it is us being in the right place at the right time. Because if you look at the cost to build a software product, it's just gone steadily down over time. In the mid 1980s, it cost $30 million to build the first version of a software product. By the early 2000s, it was down to a few million. And I remember then, boy, did we think that was cheap. But by 2010, it was probably $1 million on average. And that price just collapsed 90% between 2010 and probably 2016. So when we started in 2012, the average company raising a sub 500K round at a sub $3 million valuation was pre-revenue. And if it had revenue, it had $800 a month of revenue. So our median traction level was 0. By 2018, for us, that exact same profile, the median revenue was like $12,000 a month or something like that. Yet we were paying the same valuation. So in the 2010s, during this period of time where startup valuations were just inflating, our valuation just went steadily down. And that's because this collapse in the cost to build the first version of your product just resulted in an explosion of new entrepreneurial entrants into the marketplace.
Right. You can get to MVP quickly. You already hear them talking about Sam Altman saying we'll see, unicorn solo founders. And we'll have we'll double click into AI in a moment. But you mentioned right place, right time. And most venture firms are thematic investors. So they're saying, hey, I'm going to skate to where the hockey puck is going. They have a thematic bet on AI or gaming and crypto or biotechnology. What's your philosophy around thematic investing as you apply it?
We basically view ourselves as capital efficient pre-VC stage tech investors. And we try not to eliminate sectors based on that, because we're not going to do drug companies or clean tech infrastructure build out. And we generally won't do a medical device, but maybe every once in a while we get a company that's got a medical device or medical device technology that they're licensing, and it's capital efficient. So we would.
So it's exclusion criteria around capital efficiency, as opposed to being deliberate and saying, "Hey, I'm going to focus on these themes and bet on them and get SMEs in that market."
Exactly. So
this is what most of venture is doing.
You can take what that capital efficient sort of tech criteria, and you can figure out what markets we're over and underweight in. So we're generally a little more underweight fintech and healthcare than other investors, because it's harder to get to revenue having raised very little capital in those markets. The cream of the crop still does, and we invest in that, but it's not as common for traditional B2B SaaS. And what else is interesting is that what fits our criteria evolves over time. So in 2012 and 13, it was much cheaper to build and get revenue for a B2C company than B2B. So we were investing in a greater number of B2C companies. But as time went on, boy, the cost to drive new eyeballs to your product or app for a B2C product skyrocketed, and large enterprises became more and more comfortable buying from startups, and the software developer tools improved. And now we get companies that are building $5,000 a month enterprise SaaS products. And we sometimes come across founding teams that have bootstrapped up to 3 customers and 15K MRR, and they've raised nothing, or they've raised $100,000.
I mean, we're going to see a proliferation of startups due to the
and this is even before AI kicks in to turbocharge that whole trend.
Exactly. So let's go into that area too. So how are you seeing your startups in your portfolio transform their operations or execution with AI?
It's incredible. So I think it was probably like November-ish of 2022 when ChatGPT sort of went viral and went everywhere. And we did a survey amongst our portfolio in late May of the next year. And we wanted to find out, we did 2 different surveys. One is to figure out, or 2 different questions. We wanted to know, were you using AI operationally inside your company to get productivity enhancements? And then we wanted to know what companies were either doing an implementation to implement AI in their product or had it on their roadmap. And this was only 6 months later, and it was something like 70 to 75% of our companies were using AI in their operations.
Does that mean they subscribe to GPT and they're paying a $20 a month bill, or are they actually driving revenue or reducing costs, or it's baked into some critical workflow?
Across the board. So, a very high percentage, their developers were using, some sort of LLM or Copilot, and suddenly they're like, hey, our developers are 30% or 100% more productive. We had ones that had already implemented it and were doing it on customer service and support, and their support reps were supporting 30 or 50% more. We had companies that were using it for content generation for social media, and they're like, hey, one person can now generate 20 times the amount of content they could before. I mean, and this is just within 6 months, so it's really amazing the difference operationally, and it's going to make that capital efficient trend at this very early stage just much more magnified.
Right. And those are the use cases that are really hitting around AI: coding, acceleration, customer support, back office support, accelerated content generation. And do you see anything else in the market around AI? So it's primarily you have exposure to AI from the fact that your startups are incorporating AI into how they execute, which reduces their cost, execution, OpEx, or they can go to market more efficiently, as opposed to making a direct bet on AI. And if you were doing a direct bet on AI, it'd be $100 million valuation. They wouldn't qualify anyway.
Well, both. So what I would say is that we got a lot of exposure because in that first 6 to 9 months, when you have a huge portfolio, it's amazing how many of our companies just pivoted and changed their business model and said, hey, we're now an AI approach to this. Or we're either integrated it into their business model, or just completely pivoted and changed their business model, and where they're like, hey, this can work even better. This solves a bigger problem we couldn't previously solve for our customers. So we got a lot of exposure just pretty quickly without having to invest a dollar. I'd say we sat on the sidelines for the first 9 months when anything that was perceived to be AI that was out in the market got crazy valuations. And I think that, when we got to this past fall to now, we've actually done a number of direct investments into things that are within our valuation range that would be considered AI companies now, because it's a really interesting the whole AI frenzy is very interesting to me, because I think that what happened is investors got caught up in the frenzy. They plowed all this money into anything that appeared to be AI. And, 6-12 months later, you realize, maybe I didn't actually invest in an AI company, because the analogy I would give would be, I'd give 2 analogies. One is sort of databases and the internet companies early on. So there probably was some time in the 70s or early 80s where if you used a database as part of your back end to deliver some product, you're maybe considered a database company, right? Because that was novel at the time. Pretty shortly after that, it's like, well, every company uses a database. By the time you get to the 90s, that doesn't make you unique. And the same thing is true of the internet. In the late 90s, 98, 99, if you were a brick and mortar retailer, but you had a website and were selling online, boy, you're an internet company, right? And all these things where you just embraced what basic web technologies now made you an internet startup. But, by the time you got to the early 2000s, it's like, no, you're a retailer who just has a web presence. And I think the same thing is true with AI. Like very few of the companies that have been invested in that are AI companies actually are AI companies. I describe AI companies as companies that are building the pipes and plumbing for AI infrastructure. If we could flash forward 5 years from now, some company that's using and implementing AI in the delivery of their product, well, that's just every company at that point. And that's where we're going,
Right. Exactly. It's the TCP/IP is behind the scenes. We don't refer to it as that. We just focus on the customer experience. How do you think about the interaction between AI and SaaS? You've got SaaS in your portfolio. SaaS companies have the characteristics of some of the best business models in the world in terms of their high margin and low OpEx. At the same time, AI has a real risk of disrupting SaaS. We're seeing that now with Adobe. So, as you know, there's Midjourney, there's a generative AI that makes it easier than ever for a creative to produce an output without having to be an expert and pay Adobe an annual licensing cost. So how do you see AI potentially disrupting SaaS? And in the context of venture, I think it matters because when you're making an investment today, you're not going to harvest for 6, 8, 10, 12 plus years. And we've got the singularity event coming in 5 years, plus or minus a year, right? CEO of NVIDIA yesterday said that he expects AGI, as he specifies it, to come around in 5 years. Never mind that we don't know how to specify each other. He also follows that up with. But so how do you make an investment into that future around a category called SaaS, where these AI agents are going to come online and transform how we make decisions and access information?
Yeah, I don't think we're just a few years away from where, an AI agent replaces all software and software applications that are out there. You've got so much entrenched infrastructure and momentum around software applications, and that's how business processes are built around and what's there. But there is going to be massive disruption, and there are going to be very large companies and mid-sized to large-size tech startups who maybe some other company comes along and with 95% less people builds a product that does what they do better and disrupts them.
Absolutely.
Like it's just going to happen. There's going to be instances. And like, is that going to happen to some of our larger portfolio companies? Probably. I can't tell you which ones. But the thing is, anytime you get these new productivity tools or disruption that cause disruption sort of throughout history, that disruption is just going to happen. But it's the smaller, more nimbler companies that always benefit from it more quickly.
Disproportionately.
So the disruptors, we're going to invest in way more disruptors than we have companies that are disrupted, is our belief. And that, it's really interesting. One of the things that's interesting about AI right now is that it's the mid and small size companies that are embracing it so quickly and moving the fastest. And it's giving them a much larger edge than normal over larger entrenched players. Because if you're a large brand or an entrenched player, you've got all this, whether it's regulatory or just brands you're worried about getting, value corroded, or you're worried about getting sued, and you're not using these AI tools nearly as much. So like, what's interesting is I was talking to one of our companies, this last fall, and they're in the marketing space, and they've developed a bunch of AI tools and for content generation and stuff like that. And I asked them, what's the response from their customers towards using these AI tools? And they said, well, the largest consumer brands they're dealing with won't touch it. And they're too worried about the risk of what it's trained off of. And if, they ask it generates some image that it has an orange in it, that it's going to be an orange that was someone else's copyrighted orange, and they're going to get sued. So they're just don't want to touch anything and very leery. And you have a lot more, all their smaller and mid-sized consumer brands, though, are just embracing it and creating a lot more content and being much more productive. And so I think that's happening just across the spectrum, almost in all use cases with AI. And it's just very interesting because rarely do you get this instance where entrenched incumbents are put so much on their back heels so quickly, and
You're,
they're going to get out executed.
you're exactly right. I'll share an anecdote. I met with a friend who's a tech executive at a top 3 American bank people recognize, and he leads their cloud AI. I asked him about AI. They're testing Microsoft Copilot. But he said one of the issues that their risk and compliance teams have is they want a representation from Microsoft that when Copilot generates the code, that the code hasn't come from someone else, or that there's no other IP that came from some other. How the hell do you control for that? And that's limiting their adoption of this. That's the barrier. So legal risk, and a startup is not concerned about that. Startup's going to say, okay, can I ship faster? Okay, let's go bring in the technology to help us be more productive.
So I have another example just like that. Such a good example you gave. Like one of my kids is in college, computer science, and he went and worked for I had an internship at a large tech company. And I asked him, are you allowed to use, Copilot or any of the generative AI stuff for generating code? And he said, we're absolutely forbidden from using it. They say it's a security risk or many things. And they would never use anything like that unless it was internally built and they controlled it completely. Well, no large enterprise is going to go rebuild Copilot and do it. So, they can't stick with that position long-term, or they're just going to have competitors, just out execute around them. But that's the default reaction.
Right. It's similar to the emergence of cloud itself. There's so much skepticism of trusting a third party like a Microsoft, an Amazon, or Google.
Yeah.
And now that is the default. So they'll get there. And even they recognize that the business case is compelling. They've got to make peace with that.
The change will happen and happen quickly. I mean, it's not that different than the change that enabled SaaS companies to be so successful. If we could go back in time to like 2000, even just 14 or 15, and you're a SaaS company and you're going to try to sell, $4,000 a month product to large enterprise, your sales cycle would be 12 or 18 months. And 80% of your potential customers might be no chance they'd buy from you because it's whoever's making the decision is like, are you crazy? If I buy from a startup as young as you and you go out of business, I'll get fired. But that cultural view changed. And just 4 years later, it was culturally acceptable for people inside large enterprises to buy even high ticket products from startups. And people started to appreciate in these large enterprises that, no, this can make us much more productive. And people stopped feeling that they'd lose their job if they tried a SaaS product and the company went under. And it's caused a revolution of productivity increase, I think, in mid and large enterprises that couldn't have happened if they got over that. And the same thing will happen with AI. They'll be forced to get over it pretty quickly, is my guess. And the ones that don't might go away.
Right. And now, for the first time since the 90s, we are seeing productivity rate improve in the American economy. Perhaps this is one of the drivers. Let's talk about vintage effects. My view is venture is very crowded. My VC buddies give me a lot of flack for that. They're like, Rob, come on, you're hurting our business here. Now, I do think there are VCs that'll do quite well if they've got a unique approach and an angle and a theme and a competitive advantage. But I was at the Money 2020, which is a fintech conference, and it was like literally physically crowded. I saw like a dozen fraud AI compliance companies there. I mean, it's a great thesis. People need to protect against fraud. People need to protect against cybersecurity. But there are thousands of venture funds, and anyone who's got money is a venture investor all of a sudden, regardless whether they've got the qualifications, the skills, or the track record to do so. That's one. Two, you're seeing difficulty in venture funds returning capital, which should, I think, lead to a change in valuations and the ability of those funds to raise money and create a bit of a more capital imbalance, which would make the category attractive. But where we stand today, how do you feel about the current vintage away from RightSide Capital, just more generally?
I think so. In general, venture is totally vintage macroeconomic driven. So if you put the name of a single venture fund under a hat and ask me to guess the return, I wouldn't ask you, and I can only ask one question. It wouldn't be what firm's fund was it? It would be what year did it launch?
Yes.
I'll tell you almost everything
Absolutely.
from that. And in general, it's, the vintages from the late 2010s through 2021 are just going to be decimated. in the venture world. The valuations were so high, even if you thought you were investing at cheap valuations and, in the regular venture stages, those are considered high now. And there's just no way around that. And, one of the challenges in venture is that it's not an asset class that's like a lot of others. Like just making this up on the fly here, but let's just take even like gold, for example. If suddenly way more people wanted to buy gold and they were willing to pay 30% more, guess what? More gold would be mined. There'd actually be more gold to buy because there's more gold you can extract from the earth somewhere. It just has a higher cost. But if you're willing to pay a higher cost, it'll be there. But it's not the case that if suddenly there's 2 to 3 times the amount of dollars that want to buy venture companies, that automatically that causes there to be 2 to 3 times as many good companies to invest in or sustainable business models that can live in the marketplace. It just doesn't work like that. So when you get, if you look from, in 2013, almost no corporations had corporate venture arms. By 2019, every corporation in the world that was peripherally associated with tech and lots that weren't all had corporate venture arms or outsourced corporate venture arms. Same thing with family offices. Way back in the early 2010s, a lot of them didn't have any exposure to venture. By 2019, not only did they all have lots of exposure, but they're all launching we can just do this direct ourselves. And they're building out their own venture functionality.
I think many of them probably regret that now because venture investing is hard. It takes skill. You have to know what you're doing. On the other hand, the corporate venture arms, that's a source of exit liquidity. I mean, cybersecurity firms are getting bought up seemingly every other day now.
Right. Well, that's corp dev acquisitions is a source of liquidity. That's very different than corp dev venture capital, which is usually a very different, often a very, historically corp dev also did the investments. And then in the 2010s, you had it sectioned out where, all right, we've got corp dev that acquires stuff. And now we've got this new venture team that we have an own internal fund.
Right. What's interesting is you demarcated good and bad ventures from late 2010s through 2021. 2021 obviously being the worst. And even now there are secondary funds that are launching, providing liquidity to investors that want liquidity, including pensions that are just misbalanced. They've got too much venture than they want, and they've got to get into the right target strategic asset allocation. And if you're an LP, why wouldn't you look at these secondary deals where you've got 1, full look through and transparency of the portfolio, 2, the deal is seasoned, so you've got a faster path to liquidity, and 3, you're benefiting from that liquidity discount. It's another driver of return.
You've got so many things so my view is the venture capital industry is so distressed right now, way more distressed than it's letting on. As bad of a fundraising environment as it is for tech startups right now, it's probably the worst since 2001. It's probably the worst fundraising environment ever for venture capital firms. And I think that, because there's way too many of them, the people who are allocating to the venture world, there were so many new entrants coming in who are like, oh, they got burned, we're out of here. There's large pensions endowments who are saying, all right, let's go from 8 to 5% venture. This isn't working as we thought. Public equities are at all-time highs. It's just such an interesting time period because I would never have thought you could have public equities, including the NASDAQ, at all-time highs, and venture so distressed.
And QQQ's beaten venture. And it's liquid. And these are the best businesses in the world. And what's amazing about it is venture is an asset class that's accessible only to accredited investors and qualified purchasers. And you got to know the right person. But if you just invested in public equities, you would have done just fine.
Yeah. So, what happens is that, so I think it won't surprise me if 30% of all venture capital firms go out of business in the next 3 years or so.
I'd say more, but by the way, I appreciate your candor because I do believe there's this brave face out there in venture where it's like, hey, you know what? 21 bad deals were done. 22 is the bear market. We've cleaned out that excess and now we're back. And valuations have reset. I'm seeing $10 million
totally
entry deal. So that's true. Go ahead.
Yeah. Oh, the vintage, if you're deploying capital right now, I will say this, it's bad as distressed as the venture capital ecosystem is, and a lot of venture firms are going to go under. Boy, man, for the last couple of years and now the deals that we get are just incredible. And so for for the capital we're deploying, it is the best time to be deploying capital that we have ever seen as a firm.
Right. There's a distinction
mile,
between the performance on the vintage and the industry.
Yeah. So these will be some of the best performing vintages, but it doesn't mean it's not one of the worst times to try and raise money.
Right. Yeah. Look, I mean, they're not returning capital, these VC firms, to their LPs. The LPs are saying, hey, look, give me a few wins. And the other dynamic I'm seeing is that, especially in these club deals, we have multiple VCs investing in a deal. There's a reluctance to get a true mark on the asset. There's no incentive to have a true mark on the asset. Meaning, if there's a deal done at a certain price and that firm's got too much capital, they need to raise money again because they took in a bunch of money in 2021, and you're on the investment committee at, call it, Harvard Management Company, you're the analyst that wrote that IC memo. You don't want the bad mark. That's going to impact your bonus. The VC doesn't want the bad mark. The startup doesn't want the bad mark. There are some VCs that conduct themselves with a higher level of integrity than that, but I am seeing some indicia. I'm curious if I've seen that take place in the category. You hear about that?
I don't. So I talked to our auditor about this this last fall because I was curious, like how, because ultimately, if you're getting audited, the ball's in the court of the auditor. I mean, I think the venture firms, if they're a good firm, they should just be marking to market anyway, and being honest with themselves.
And it's hard to mark to market. He's real liquid, obviously, and this right. So, yeah.
But I talked to auditors and they said, because I thought, did you have a lot of difficult conversations in 2022? And they said some, but 2023 is going to be the real bad year. And basically, it's really interesting because in 2022, it was just a valuation collapse across, almost all sectors, not all, but most companies hit their sales targets. Like there was big sales tailwinds. So companies' valuations were going down, but they were still crushing their numbers. And so you got to the end of 2022 and you had some venture firms and they were still holding their marks pretty high. And they could say to the auditors, well, this company has got a bunch of, has 18 months of runway. It's growing quickly. It's going to more than grow into that valuation. So we're comfortable keeping it there. And I think the auditors often let them because that was a rational argument. And then 2023 came around and boy, you had the belt tightening across the corporate ecosystem. And suddenly everyone missed their numbers in the SaaS world. And that 18 months of runway became 9 or 12. And now you've got 2023 where, hey, fine, this company grew 150% in 2022. It can justify a high multiple. Now it just grew 20%. And you can't justify a high multiple. And so my feeling is that in Q4 of 2023, there's going to be a lot of markdowns, and that when
I agree, I think that'll happen in other private asset classes too, like commercial real estate. But look, there's not many forcing functions. If you raise new money, you got a new price, you got a new mark. That's a forcing function. If you're issuing options to employees at a lower strike, you recap, that's a forcing function. But there's, auditors are not investment bankers that do valuation work. They're validating the representations of warranties and the financial statements and doing a tie out. And startups shop for the lowest auditor or whoever was referred to them by their VC.
Oh yeah, I'm being more like that. I'm not saying the auditor for the company. I'm saying the auditor of the VC fund. They're actually looking at the valuations, and that's where you should be getting pushback.
Gotcha.
I mean, ultimately, I think venture firms like the concept that, hey, I just hold this mark at value until there's a next round. That's not what you're supposed to do as a venture.
Right.
You're supposed to market to market. We don't do that.
Right.
I mean, for our companies that grow large and have a material financial impact on our funds, if multiples collapse, we mark them down aggressively. Like that's what we should be doing. And we never mark them up crazy too. So, I mean.
That makes sense. Makes sense. But there's shenanigans out there. Ventures changed so much from the early days when it was a cottage industry that was built by the Moritz of the world and the Sequoia Capitals of the world. And now it's become industrialized. In 2021, it became mass produced startups, hire the VP of sales, ramp up growth. Don't worry about CAC, max revenue growth. We recalibrate. Like, do you have other broader thoughts on venture as an asset class and as an industry?
So I just think that generally, if you look at venture capital in the 90s and 2000s, it was a very sort of non-transparent, high friction market, somewhat dysfunctional, very opaque. And, that meant if it's 2004 and some company venture firm leads some company's Series B round, well, if you're another venture firm, you couldn't find out necessarily what price that round went off at or what revenue that company had. And even if you are a startup looking to raise capital, you couldn't even go look online and find a list of VCs that were, right for your vertical. It was really hard to even connect. And all that's gone now. It's like, as a venture firm, I can subscribe to products where I just find out the pricing of virtually every round, and often the revenue that's there. Right. I don't have nearly as big of an edge, if I'm a Series A or B VC firm and everyone knows about me, because everyone knows about every venture firm. And so I think just generally venture as a whole, if you look, say, from the 2000s to the 2010s till now, it's just become a more efficient, transparent market. And so I think it's harder at traditional venture stages to, consistently derive excess returns from a market that's getting more efficient, where both the startups and the participants know much, much more about each other and what's going on. I mean, there's just no way around that. The greater level of transparency, data equality, and efficiency that happens in a market, excess returns tend to get arbitraged out over time in all markets. Right. And I think there's a risk that happens, to venture eventually, or maybe it is happening, I think.
No, I agree. And how about geographically, taking a step back, when you look at the United States, it has a dominance in capital markets, right? There are foreign flows that are pointing to U.S. public equity markets because we've got the best businesses in the world, including public listed software firms. Like, look at Mag 7. These are all former startups: Amazon, Microsoft, Google, and so on and so forth. What are you seeing internationally? I don't know to what extent you cover international firms, but India's on the rise. Seeing that, for instance, there's a ton of talent in China. The different frictions around that, of course, too. Any thoughts on international innovation?
The biggest thing. Well, so there's two things. I mean, there's one is like what's required to have like a solid culture of entrepreneurism that really overhauls your country or continent economically and makes it and has big impact. And I think the biggest thing required is a cultural shift. And this is America's huge edge for a century, which is that you cannot get a scarlet letter etched in your forehead if you do something and fail, right? In America, it's always been viewed that if you launched a company and it failed, that, wow, you must have learned a ton and you must know so much more now than what you did before.
Right.
I remember in the early 2010s talking to entrepreneurs in Germany, and they're like, man, if you do something and it fails, you're marked for life as a failure. Like the risk you take as an entrepreneur. And I think that's changed a lot in Germany since, over the last 10 plus years. But I think that's such a cultural edge when you can have entrepreneurs that can go in and fail multiple times and then be wildly successful and then create a company that becomes, one of the top 5 largest in the world. You're going to do that regularly. And when you're in an environment, and I'm guessing China, I think more like that, where you fail and you're demonized and you're marked as a failure for life, that's just not a cultural environment where you're going to get this economic revolution built off of tech startups. That's sustainable.
Right on. And we have the American management and principles like product market fit that has, I think, trained recent vintages of entrepreneurs. We got the angel ecosystems, universities that are cranking out talented graduates that can build something special here. Are you seeing certain markets though start to generate high quality opportunities, entrepreneurs, and ideas? Right, we've got Helsinki, Finland, Linus Torvald. You got Ukraine, Poland, South Africa.
Everywhere are great companies and great opportunities. So like what we saw, like even here in the U.S., like if you went back to the 2012, 13, and 14, one of our premises is like we'd rather invest outside of the Bay Area or New York City, because we get the same company with just a much lower cost structure.
Another non-consensus idea, right?
Yeah, which at the time was viewed as crazy, and COVID sort of made that look normal because everyone moved everywhere and everyone started investing everywhere. But the challenge as an investor is not just getting good companies with good entrepreneurs and good traction. Like always have seen companies in South America that great traction, we can get at great valuations. The challenge is it's not just a good entry point. You have to be investing into an active and liquid exit market. in order for you to get good returns as an investor. And there were never lots of exits in South America. So like we'd see these great companies, but we just do the math and there's just not enough exit liquidity. There's so many more acquisitions that happen to US companies.
It's a fair point. Are the markets you find attractive though? I look at like Brazil, for example. You've got Nubank, you've got Mercado Libre. Colombia, there are some private equity takeouts. I don't recognize any publicly listed.
It's starting to change in these places, but ultimately, before you get consistently high investment returns, you've got to have active and liquid exit markets. So I think India is probably poised, because they've got a pretty good culture of entrepreneurism. They've got a pretty established, angel and VC market. They've got public markets. They've got sort of all the tools in place for that to really.
Yeah, no, it's a good market to look at. And the public equity markets are up and to the right. There's a lot happening there. And just on the last topic here, what are your thoughts on the proliferation of these accelerators? So in the beginning, there was Y Combinator. There's so many copycats now, right? Sequoia's got a Y Combinator copycat. Bain Capital does. Peter Thiel's got one. They probably wouldn't call them copycats, by the way. They're accelerators. There's A16Z has one where. Go ahead.
Yeah, I think it very much depends, because I think the startup accelerator world exploded in the mid 2010s and accelerators were everywhere. But there are these independently run ones, right? And it ends up being way, way harder to make the math work, because although it can be attractive returns, you've got to have so much money to put out for a decade straight before you're getting much money back in. And accelerators generally are raising from individuals, and those individuals get tapped out. And so it's just really, really hard to make the math work out such that you can, have enough people to fundraise from for a decade to stay alive. I think the ones that are being done by the large venture firms, it's very different motivations and dynamics, because they don't actually need to make great returns off of the dollars they're putting in to the accelerator. So they can have very different investment criteria. Those are really all farm systems for their larger checks that they want to write. So their motivations and what they judge, their methods of judging those programs as successes or not are very different than how, an independent accelerator has to judge. Their judge is purely on returns.
Well, I agree. They're farm systems, and that's the only way they can get a good entry on valuation.
Yeah, in normal markets. In today's world, it's such a tough fundraising market. If you're deploying capital, you should be getting great deals at every stage. But this won't last forever, and it's going to go back to being very competitive and very crowded.
Right. And another point you're making there is like the accelerator business model is a tough business model, because unlike a venture fund where you can call in LPs, you've got to take in new capital on demo day. You're relying upon angels, and angels are not the same kind of committed capital.
Yeah. And I'm meaning angels like to provide the capital that the accelerator uses to do its operations and to do its initial small investments into the company.
To fund call it the GP or the accelerator, the
operating costs and that initial investment capital that the accelerator is doing when it's giving 40,000 or 140,000 on the way in. It's like, hey, that might be $3 million a year you need, but you don't need that for a few years, and suddenly the money is recycling and you're self-sustaining. You need to put out $3 million a year for almost 10 years straight before you're getting enough money, and it's hard to find that.
Tough business model. What are your thoughts on the incubator business model? Maybe you want to thumbnail what that is too, just to draw a contrast for the audience.
Yeah, usually accelerators are taking in companies that have already established founding teams and products and sometimes revenue, and they're trying to accelerate those programs. They go through a program, and the idea is you sort of move forward 6 or 12 months and 3 or 4 months, and we help you get fundraised. Incubators are generally coming up with their own ideas, and they have their own teams and throwing ideas against the wall, doing tests, getting an idea they think will work, and then go building a team around that. And I think with incubators, the attractive part is that you can have greater ownership and you can have a higher quality team, because you can get product and some validation and build maybe a team around it. The challenge is it's hard as an incubator when you get farther down the road and you're fundraising, because you end up with a very weird looking cap table often. So like where this incubator organization owns a very large chunk of a company, and when you get to sort of seed, Series A, B investors, they don't like it often when you've got these large
Right, because
chunks of the
founders don't
company.
own enough of the company.
And that's the founders don't own enough, and so it's got its own challenges. I think if you do if it's an incubation model and it's backed up by huge dollars, and you can really fund this to where it's traction levels that people can't say no to, then that's great.
Right. We've seen some success stories like Dapper Labs, which created NBA Top Shots, but these might be exceptions to the rule.
Yeah, it's really hard to know because there were so many incubators that were created during the bubble time and spun out companies, and just companies could get to just small levels of funding and suddenly raise a $4 million round. And that we're never going back to that, and it's I don't have a strong, I think well-run incubators can probably do very well in a normal market as well. Today's market, it's more of a challenge, but I think in normal times, yes, but it's not just, incubators were just free ways to print money in 2020 and 2021, right. And they're not going to go back to that.
Right on, right on. Any other thoughts? I mean, I've really enjoyed this. Every tech company is a black swan. That's quotable.
A potential one. I think the major successes are just positive black swans.
Positive black swans.
Negative black swans.
I guess we can't call them white swans because the metaphor doesn't
work
anymore.
That doesn't.
We need a different dimension.
Right. And for those who haven't read the book, the term the black swan, I guess in Europe for ages was, someone would say that's about as likely as the black swan, meaning that's just physically impossible to happen.
It goes back to philosophy, actually. I think it's the Vienna Circle.
Oh, okay.
Like
there you go.
Logical positivism and all the rest.
And then Australia was discovered, which had black swans. So it turns out that
someone found the black swan.
Yeah, so things that you think are impossible actually do turn out to exist a lot. So that's sort of where the term came, that there are these very unexpected events. And then in hindsight, it's like, oh yeah, of course, there are probably swans of all different colors out there. So
right. How can folks learn more about RightSide or follow you or RightSide?
Yeah, if you want to learn about RightSide Capital, you can just go to our website. If you want to reach out to me directly, you can just email me, dave@rightsidecapital.com, and I'll talk to you or put you in touch with the right person at our firm, depending on what you need.
Terrific. Thank you for the time. And for those listening now, you can follow Lumida Non-Consensus Investing. It's the name of the podcast. It's on YouTube. It's on Spotify, Apple as well. We've also got Instagram and TikTok. So look up Lumida Non-Consensus Investing. This will be out there soon. We record this live as we always do. It's always a lot of fun. And thank you, Dave, so much. Really enjoyed it. Take care.
Sure. Thank you. Pleasure to be here.